What's up, everybody? Welcome back to We Talk Money. I'm your host, Chris Dunn, and I've got Nikki and Travis.
Hello.
My co-hosts. We got Kevin on the ones and twos in the background. It's good to be back in the studio.
Good to be back.
I know.
Where you guys been?
I feel like I don't even know how to act anymore. We've been not in the studio lately that much, so.
It's good to see you guys. Yeah, we've been, let me see. We did some mountain biking. We did some hiking. We did lots of beer drinking. Lots of brewery hopping.
Yeah, I've about had it with the booze at this point. I'm like
back to Waterloo's we go. Yeah.
Still trying to lose this COVID weight.
Well, hey everybody, welcome. If you guys are watching live, thanks for being here with us. We're going to do some Q&A shortly after we go through the charts and the news and all that stuff. If you're listening to this on the podcast or watching it after the fact, thank you. Feel free to share this up. And also thanks to our sponsor, Y Charts. We'll pull that up. Y Charts is a great place for all things macro and stock and crypto research related. Yeah, let's go ahead and jump right into it, guys. Looks like we're ready to go. We usually don't do these on a Thursday, but our schedule's been kind of thrown off because we've been traveling, hopping around here and there for the summer. And yeah, let's jump in.
Are we diving right into the resistance test, the big 40K breakout test on Bitcoin right now? Is that what we're diving into first?
Nope, we're going to save that for somewhere in the middle.
Everyone's wondering, is it going to break out? What's Bitcoin doing?
Yeah, actually, I mean, there is a lot of excitement around Ethereum today. We'll talk about that. This is also testing a major resistance level. So, you know, I actually, why don't we just start with my tweet? Where did my tweet go? Here we go. I sent this out earlier today and I said, is altcoin season over or are we going to get a second bull run in 2021? And it looks like about 75% of people think that we're going to get a second trend incoming, and about a quarter of people, so a little bit less than 25% of people, say that alt season is finished. What do you guys think?
Well,
I mean, I think that if Bitcoin runs again, right?
Yeah, Bitcoin's the DJ that kind of decides how long the party goes on. But we are seeing signs of uncorrelated moves in a few different assets, which is always a healthy sign. And yeah, I mean, so for anybody that doesn't know, back in 2017 in the spring, we had the first altcoin season. And then things looked like they were over and pretty much dead. And then, wha-bam, second half of the year came around and things went parabolic. So if the markets play out like 2017, which there's no guarantee that it has to, but if they do, we could see, because we haven't really seen parabolic blow off tops yet. Bitcoin didn't have a parabolic run. It was basically a healthy trend, got overheated, but never really saw like true parabolic price action. And then it pulled back. Ethereum, you could make an argument that it got parabolic above, when it went from 3K to 4,500 almost. But
I wouldn't even call that a parabolic move. And
yeah,
I mean, when you compare it to other
the trend
moves.
started to speed up, which is why I took profit here around 4K. But I don't know. I'm still holding a pretty large position and honestly looking to build back in, but trying to be patient so I don't get trapped.
Markets rarely do the same thing that they did like years before, even if it's a similar cycle.
Yeah.
So I would be surprised if like the alt season follows the same exact pattern that it did back in the last super cycle.
Yeah.
Plus, I think there's a lot more happening in alt projects, and with especially on the Ethereum side, some of the DeFi stuff. There's actually a lot of development going on.
Yeah.
And I know we were even talking a little bit about like some of the games being built, and NFT stuff, obviously. So there's a lot happening that could really still give a lot of juice to alts, in my opinion.
Yeah. I mean, AXS is basically a gaming token that's gone crazy since the beginning of July.
That's Axie, right? Axie Infinity.
Axis, yeah. So we'll pull this up on Masari and we'll talk about this. But we over the past few months we've talked a lot about gaming and like the metaverse and like decentralized worlds and stuff. And this is a really real use case, but you have to be careful about the tokenomics because some of these projects don't have fixed supply of the tokens. Some of them aren't fairly pre-mined. Some of them have really arbitrary rules. So if you're going to quote unquote invest in gaming tokens, really understand what are the key risks, right? Like, is there a small group of people that control a majority of the coins? Is there unfixed supply? Like things like that. And just know you can trade this stuff. You can buy and sell and take value out and put it in other places, but just be careful if you're going to buy something that's up over 1,000%, expecting it to keep going without a pullback, right?
Can someone quickly explain to people that don't know and to myself what exactly is this gaming token representing? Is it? Can you explain it to me? Because I don't know.
Yeah, I mean, we will do a in-depth masterclass on gaming tokens here in the near future.
We will?
Just for you. Yeah, maybe we'll do a live stream.
That would be awesome. And I can ask all the questions.
Yeah. Okay. Because there is a lot of development. There's several different ways that people are trying to attack it. But the general theme is either having native currency or, finite supply of in-game assets and things like that. And there's so many different variations within that subculture. So
there's so much to learn in crypto. It's almost impossible to keep up with it all. It feels like there's always something new coming in this world.
Yeah.
And is that making certain altcoins irrelevant faster, or how is that changing?
Making certain altcoins irrelevant faster?
Either other things are coming onto the scene that are better, or doing things in a better way, and then these other tokens end up kind of falling.
You're talking
about
about gaming specifically? Or?
No, in general, like alt season in general.
Yeah. Look, every market cycle, coins die and go away and never come back.
It changes so fast.
Right. But then you have some that survive the test of time, some that grow and make higher highs each market cycle. So yeah, it's just like the startup world, right? Like most of them are going to fail over time, and the few that survive are going to really entrench in whatever value they deliver. So let's go ahead and let's go into the news. I mean, so the title of this, which is kind of like, FUD based, is like, will governments crush cryptocurrency? And I think that's a really important question to ask because governments are scared right now. They're going, okay, enough is enough. Like this is getting really big. We're now in $1 trillion plus territory. it's funny because you've got some regulators that are like fighting over control. You've got certain senators that are trying to sneak anti-crypto regulation into the infrastructure bill. You've just got a really weird time right now, and people that are in the crypto space need to be aware of what's happening and take whatever action we can to support the future of crypto, because if everybody just kind of lays down and is quiet, they're going to be able to work some of this shit through. So, yeah, is it a scary time? Yeah, it should be, because this was never going to be something that just grew to maturity without people trying to fight back against it, right? The entrenched powers that be don't want to give up power, right? They don't want to give up control of the monetary supply. They want to, protect investors by making sure that only millionaires can invest in tech startups. They want to encourage lottery and gambling while, startup investing, no, that's too risky, right? So it's a weird time, but this is a necessary fight that has to be fought.
I mean, I think that I haven't actually dug into the details of what exactly they're trying to do. I mean, regulation was inevitable for mass adoption, right?
Yeah, but how much, right? And Trav, you said you were digging into the infrastructure bill and you already found some pretty ugly stuff, right?
Yeah, the bill is not totally finalized, but there was a draft put out. I think it's like 1,700 pages. So obviously I haven't read through every single page yet, but I was poking around in there. I kind of wanted to see like if I could figure out what stocks might benefit from some of the different sections and some of the allocations of capital. But I mean, it's $1 trillion infrastructure bill, and it's going to have so much pork. And already in the draft bill, there's a lot of stuff like, there's stuff about potentially having a miles driven tax for vehicles, and there's stuff for, there's obviously the stuff that's been reported on like vehicle charging infrastructure and nuclear power tax rebates and all that kind of stuff that gets reported as headlines. But there's a lot of little details in there about all these other things like electrified school buses and all these other things within it. So there are going to be favored companies and favored projects that get a significant amount of money. I mean, several $1 billion is a very, very tiny fraction of this overall bill, but for some, senator's friend's construction company, that's a life-changing amount of money potentially. Yeah. So there's going to be a lot of weird stuff coming out, and you can go look for yourself in the draft bill right now. Obviously, like I said, it's not totally finalized, but there's going to be a lot of eyebrow-raising stuff, and some of that is actually regulatory.
Yeah.
So yeah, they're potentially going after crypto tax reporting. That's part of the bill. There was other stuff about. Well, yeah, I'll just stop there. But there's some weird stuff in there.
Yeah. For anybody that doesn't follow Jake Chervinsky, I think is how you say it, on Twitter, he is, I believe, general counsel for Compound. And anyway, he's always tweeting really insightful stuff about regulations. And so I'll link this up in the show notes. But basically, there is a way that you can reach out and actually take action against the anti-crypto part of this, and you can read in detail about what this is. But essentially, the way that I understand this is they are trying to redefine what a broker is, and basically just severely overreach and try to get a hold of all of your data, basically turn everybody into a quote unquote broker, to where anybody that does any business related to crypto is going to have to jump through incredible hoops and just have egregious record keeping and all that. And so this is absolutely something we want to push back, and at a minimum, read through it. And if you have time, try to take some action, call your senators. It does help. That's what I would say. And then on the other side, so Gary Gensler has been, in the news recently talking about the fact that they're going to try to step up regulation in the crypto side of things. We knew that this was coming. If there was anybody that I had to put in charge of the SEC to be, I guess, as crypto friendly as possible, as far as I know, it would be Gary. This guy has taught classes on crypto over the past few years. I met him at a party 4 or 5 years ago. Seems like he really means well. He's obviously a smart dude. obviously regulation is a part of crypto, no matter if you want it or not. I think we got to flush out the scams, but at the same time, we can't stifle innovation. And so I think this is more so FUD, what's been floating around on the SEC side. The thing that really freaks me out more so is this kind of regulation that they're trying to cram through that would severely, severely hinder future innovation. So that's kind of my 2 cents on it.
I'm hoping that they don't make the use of cryptocurrency such a miserable experience because of all the bureaucracy and the reporting and on the tax consequences and all of that. Like, I'm really hoping that there can be some type of happy medium here, similar to like equities, you know, and other assets. You know, you have to track your cost basis, you have to track your transactions, but you know, the broker helps you out by sending out a 1099 at the end of the year, showing your transactions. I'm hoping that there can be something that can happen here, but crypto is kind of such a wild land in a way between using things like DeFi. That's, I mean, is that stuff even tracked at all by anybody? No, right? So it's like totally up to you. I guess, I mean, I don't really know what the solution is, but I'm really hoping that, I mean, I imagine the government wants the tax money that comes from profitable crypto trading and transacting. So I'm hoping that they make this to where we can all work together here.
Look, yeah, there's absolutely no easy answer, but I do think we have to, as a community, do the best we can to kind of self-police and flush out the scams before they get too big. You know, we saw what happened with BitConnect. We saw, you know, there's example after example after example. And the fact that some people still haven't learned from prior market cycles and are still doing the same shit tells me that, yeah, maybe regulators do need to step in and put the hammer down on some of this stuff.
Exactly. Like, they just don't want, like, the SEC doesn't want investors losing their asses, right? And those are the types of situations that happened in crypto.
Yeah.
And
yeah, rug pulls, you know, it's a love-hate relationship.
yeah.
But at the end of the day, I don't know. I just feel like the more immediate thing we got to focus on is not letting any anti-crypto regulations slip through this infrastructure bill. Then we can breathe and like move on to the next step.
Yeah.
All right. Well, next up, I just want to say congratulations to Masari, who is, you know, this is a website that we use. We're not sponsored by them or anything, but this, I think, is just a good research tool and a good filter for, you know, looking at different crypto projects. They just raised, what, another 25 million bucks, $21 million. A16Z is a part of that. Steve Cohen, or no, wait, I'm sorry, not A16Z. That was another round. Steve Cohen led this round and just shows that, you know, good companies in this space can still thrive within the existing regulatory framework. So we don't have to go and like create a whole bunch of new stuff just for crypto. Like it already exists, right? So good companies can still raise money, can still make a lot of money, and have progress without regulators trying to change everything. Also, talking about Ethereum today. So we've had a little bit of bullishness yesterday and this morning. We're back up above the 100 period and the 200 period moving average, challenging 3K resistance. And that has been driven by EIP, so Ethereum Improvement Protocol 1559. Basically, so I'm not really technical, so I'm going to screw this up if I try to sound too smart. But they're basically just trying to make the transaction fees more efficient and, yeah, just continue towards the path of ETH 2.0. So,
and part of this actually burns Ethereum at certain times, right? So it could actually reduce some of the supply.
Yeah. As the congestion in the network picks up, more is burned. It's kind of, you know, like another experiment in self-monitoring and trying to help scale over time. I love all these little experiments. This one's not so little, but, you know, it's definitely a step in the right direction. Yeah. So, I mean, just again, another bull case for ETH, another bull case for all the kind of tokens and networks attached to ETH. And yeah, we're just making progress.
So everybody's probably thinking, should I buy Ethereum and Bitcoin right now?
Oh, are you asking that? Well, my non-financial advice is going to be no. Yeah, so I mean, look, I'm long. All I can do is tell you what I'm doing, which is I'm still long. Been long since 300, added on the 1400 all-time high break, took profit into the big spike a couple months ago, and I'm looking to build back size, but I only have entries and exits whenever I have a trade set up with rules met or I hit a profit target. So I don't just randomly guess when I'm going to buy. I look for specific things, and if those specific things aren't met, then I sit on the sidelines.
Amazing how this is so funny because it's amazing how crypto went from, or Bitcoin specifically and Ethereum, the charts are basically the same right now, right? Pretty much.
They're similar.
Yeah, like they went from being extremely bearish, like people thought that we were going to be breaking support and retesting 20K, including myself at one point. And I know I said it on the show that like,
sure,
hey, if this breaks down, I think we're going to see 20K pretty quickly.
Yep.
And it held, and now it's actually looking extremely bullish to me.
Yeah.
So it's just, this is, and someone commented on that show and they're like, you said it was going to go to 20K and it didn't, blah, blah. And now look at it now. And it's like, no. Look, this is why we read price action, and like we were talking about paying for confirmation. You weren't making any moves at the time because you weren't truly sure what was going to happen. And paying for confirmation helps you confirm that trend. And it never broke support like fully to where we saw that sign that 20K was going to test. So, and now, boom, it reversed right back. So this is why paying attention to key areas on the price charts is so important, because it can, like, it would have kept you from either shorting it too soon or going long too soon. You know, we were just in this like consolidation choppy zone.
Yeah, and that's typically what happens is after you come off of a big bull trend and you have a deep, scary pullback, right? This is a 55% pullback off after all-time highs. The market needs time to kind of coil up and consolidate for new momentum, right? And so that's why in the community and even on the show, I said, look, I'm not going to overthink this chop area. I don't try to speculate and buy and sell inside of a tight range. I sit back and I wait for very clear patterns. And yeah, as of like this day, and I was even like joking on Twitter, posting like inverse charts showing this as like what it would look like as a breakout trade. And I'm like, yeah, you know, look, if this breaks down, I'm prepared to buy at 20K, but I'm not shorting prior to that level, right? Because what can happen is if, just as we saw, if support holds and you get that initial buying, that's going to squeeze shorts really quickly. And that's why we had a couple of weeks right back to what we call open air, right? So we went from strong price zone to strong price zone, and here we are kind of chopping over under the 100-period moving average now. But yeah, I guess the lesson here is just don't over trade during choppy time periods.
Yeah, and someone said, pretty sure I said 20K was inevitable. I will have to run back that tape, but if that support was gonna break down, yeah, I think 20K was inevitable.
Yeah.
And that day, things looked really bearish.
Yeah.
I mean, like you said, you posted that chart, the inverse chart, and it looked like it was gonna break. It really did, but it held support to a T, and
now,
it
so
didn't.
what do you think about that 40K break? Because you could make the argument with the break of 40K, you're in a different structure, right? Microstructure, right? So
yeah, there's still a lot of overhead resistance. Like, look, we've still got the 200-period moving average here at 44. You've got the strong prior resistance level around 45 to 50K. So for me, the trend is not back on in full force, right? To me, we're still mid-range. I'm not overthinking this. I'm waiting for basically confirmation that market structure has shifted. And what that means is getting back up above the moving averages, starting to put in like stronger, higher highs and higher lows. You know, back here, like when you're getting run retracement to the upside in the first 6 months of the year, you know, that is significantly different than when you're back below or in between the moving averages and you've come off a 55% pullback in price. Oftentimes the trend doesn't just reverse automatically. It takes time to work through that bearishness. So that's really what I'm waiting on. And by the way, I'm still long. I'm not net short. I'm long. But.
Do you add a little on the 40K break and then wait for a more clear breakout above to add real size?
That's what I've been doing. Yeah, like I like to scale in and then wait for key capitulation moments, right? So either like a massive washout over the course of 3 days or a clear breakout of a very strong resistance area. But again, 9 out of 10 days, I'm not doing anything, right? Like I look at the chart and I say, this is what I'm looking for. These are the key zones I'm waiting on. And if they break or if I have a setup, great. If not, I sit back and let the price chop around. So I would actually say Ethereum has more overhead room, right? Like this one has much stronger resistance around the 28 to 2900 level. And really the next strong level before that or next to that is 4K. So if we get a strong breakout of 28K, I wouldn't be surprised to see a pretty strong, fast move to 4K to retest that. Have to keep our eye on that over the next few weeks.
Word.
Word. All right, let's see. So what else do we have on the docket? I think there were actually, oh man, anytime I get a chance to laugh at Jamie Dimon, I have to pull this up. You guys have seen this back in 2017 when Jamie Dimon was calling Bitcoin a fraud. As of today, we got another juicy article. JP Morgan pitching Bitcoin fund to wealthy clients.
Oh, is this what we were talking about?
Yeah, you brought this up. Yeah. But I just love seeing these side by sides because it's just so funny how the banksters will capitulate. And Trav, I know you love Jamie Dimon. I'm sorry.
Isn't he a DJ?
That's Lloyd
is that the
Blank.
other one?
That's Lloyd Blankfein.
Okay.
That's the former Goldman CEO that also DJs on the
Dang.
side.
I was gonna give him some brownie points, but no, he's not a DJ.
I do like Jamie Dimon. I mean, you can't argue with his results at JP Morgan Chase over the past like 2 decades. I mean, he's absolutely built the best traditional bank in the U.S. And the numbers show that. The valuation and the performance of the stock show that. And he's a very measured guy. But Bitcoin's been a blind spot for him for years.
Yeah.
And he failed to rethink his position for the most part. Like even I think a year or two ago, he was saying on conference calls when he was asked about it that he wasn't going to talk about it anymore.
Yeah, you could tell he was getting real irritated too. And I mean, can you blame him though? He is the incumbent.
Yeah.
Like he has the most to lose from Bitcoin, really, right?
Yeah. I do wonder about the future of JP Morgan Chase. Obviously, they have a tremendous balance sheet, so at some level they'll be fine. But they have really missed out on a lot of not only crypto related opportunities, but also a lot of stuff in fintech generally.
Yeah.
I mean, Square and PayPal and companies like that have been starting to nibble away. Even some of the buy now, pay later companies, which I'm sure we'll talk about later, are starting to nibble at like the credit card business, mortgage lending. You've got non-traditional lenders like Rocket and all the others that are now competing in that business. So they're under assault from a lot of different angles.
Yeah, as they should be. I mean, there's a lot of bloat in financial services. What was it or is it? It was like 7 or 8% of GDP was financial services. Does that sound right?
Yeah.
Something like that's massive. That's so much middleman bloat and so much room for disruption, right?
Yep.
And it's happening. I mean, you guys have recently had some plays in fintech space, and I don't know. Is this the next thing we've got up here? Affirm?
Oh, it was the Square Affirm deal. That's the Apple.
Square Afterpay. Yeah, Square Afterpay
article.
was the big deal.
Sorry.
Yeah. I know it's confusing, right?
That article. I was looking at that article, which had Affirm and Apple, and this. Ignore me.
Okay, so let's back up. What's happening in this space? I know there's been a lot of disruption.
Acquired Afterpay.
Okay.
Yes.
And Afterpay is
a
buy now, pay
later software company.
So they're basically doing like subprime lending for consumer purchases. Is that kind of the way to think about it?
I think Afterpay is prime consumers. There is Catapult.
Yeah, they do subprime.
They do subprime.
Yeah, there's a few others do subprime.
But basically, Square paid $29 billion for Afterpay. Eye-popping number.
Over 40 times this year's expected sales. Yeah, 42
Woo.
times sales. So very rich valuation.
Woo. Yeah, it's high.
Afterpay has been a phenomenal stock for those who've owned it.
And Afterpay is an Australian company.
Yes.
And this was a really big deal in the space. And we were following it pretty closely because I know you, Trav, you've been looking at Catapult for a while.
I've been spending some time on the buy now, pay later space as a whole. And I started looking at it because of Catapult, because it was a SPAC on a relative market cap basis, is much, much smaller than some of the big ones. And they serve a subprime market, which is a little bit unique. So I started looking at that one. I now have some intriguing possibilities outside of that. We'll talk about that later.
So basically Square just made a new all-time high this week or today.
Yeah, it's actually...
That's coiling up, looking like a breakout.
It's a big breakout for Square right now. If it can hold it, it's pretty phenomenal, the strength that this stock has. It's still a market darling after all of these years. And
man, you nailed this one. You picked this up at what, $9-10?
$9.11.
Hell yeah. Amazing.
And then we picked it up again in the March 2020 panic.
Okay.
So, Trav and I are still holding, I'm pretty sure you're still holding a lot of those shares too.
Yep.
So just a phenomenal multi-bagger that we have on Square. And, as rich as the valuation is today, I mean, it's still performing. The price action is still so strong, and now they're making these acquisitions. It's going to be very interesting to see where Square can go from here. But we were a little perplexed or at least I was a little perplexed at first as to why Square would pay so much money for Afterpay, because I've mentioned before that I feel like the buy now, pay later, aka layaway, essentially, except you get your goods today. It's more of a feature, and I'm thinking to myself, okay, and this was before when Affirm IPO'd. I was thinking other companies and banks can implement this themselves. And now we're starting to see that, like American Express is starting to implement it. Apple is working with Goldman Sachs to implement a buy now, pay later through Apple Pay.
So wait, sorry to interrupt, but how is this different from just using a credit card?
Do you want to take this?
Yes.
Okay, go.
So I approached this initially with a lot of skepticism for that reason, also because of competition, also because I'm like, this is just layaway. We've had layaway for 100 years.
But you get the product now, right?
Except you get the product up front. But
so it's like it's still just financing the purchase.
Yeah,
Yes.
but here's what's different about it, and here's what's actually pretty intriguing, and why I think Square actually paid this massive amount of money for Afterpay. So millennials and millennials, Gen Z, some of the younger spending cohorts are changing their behaviors pretty massively from boomers and Gen X and the ones that came before them, in the sense that their credit card usage is much, much lower. And there's a couple of reasons for that. One is just age. Sometimes it just takes a while for people to get credit availability. But some of the big drivers of that is they saw their parents go through the financial crisis, have credit card debt, deal with issues around credit card debt for a long time. So there's a lot of reticence to take on credit card debt. Credit card debt also comes with like 20 to 30% interest rates. And you have these revolving balances. It's a different product than buy now, pay later. Buy now, pay later, a lot of the buy now, pay later stuff, like through Afterpay, you do in short, 3 or 4 payments. So
it's like an installment loan.
Yeah, exactly. So you can essentially manage your cash flow almost the way you would with a credit card, except that your interest, they're not charging you 20 to 30% interest rates. And you can do it on, smaller purchases. And there's a lot of interesting, unique aspects to the way that it's being used by these consumers, that essentially it becomes a replacement for credit cards. It becomes a way for, here's another problem. We've seen a huge rise in debit card spending by millennials because they have been not either able to get credit cards, or because they've decided that they don't want credit card debt.
Thanks to Dave Ramsey, probably.
Yeah. So, and that's actually probably a good thing, right? Because credit card providers are not incentivized to help you as a consumer. They're incentivized for you to have late fees and pay high interest. That's how they make the most money. So what's happened is debit card usage has risen a lot, and credit card usage has kind of flattened off. And the problem with debit cards is there's some purchases you can't make with debit cards. Certain larger purchases you can't make with debit cards. There's just certain types of purchases you can't do, right? So that pushes people into buy now, pay later types of solutions. There's a lot of really interesting aspects. And for merchants who offer buy now, pay later, it allows them to offer, to get purchases from a broader broader consumer segment. So there's all these interesting aspects to the buy now, pay later experience that initially I was like, this is just stupid. This is just a feature. It doesn't make sense. But now I'm like, in the context of behavior changes from consumers and the way that it actually works is different from a credit card. So it turns out that this could be disrupting the credit card industry, which is look at the market caps of MasterCard, Visa, the banks like JP Morgan that provide credit. These are hundreds of billions of dollars of value.
And their stocks are still sky high, right? Looking at Visa.
Yeah.
That means they're going to have to really work hard to keep the rewards going.
Yes.
And make the cards very appealing on the reward side, because they're going to have to reduce interest rates or something.
Yeah.
If this is truly something people can do. And I know that I believe Affirm and some of them, don't they pull like soft credit? Like you can't. It's not just for anybody, or can just anybody go and do this?
So some of them are using their own credit models, which is another interesting aspect, because they're not doing hard credit checks. Some of them may be doing soft checks, but a lot of them, like Affirm, they're using their own credit scoring models that are not FICO credit score based. That's another intriguing aspect. You can't get a credit card if you've never had credit before, if you've never been able to build credit, or if you've had a missed payment or something like that and your credit score is under 700. You can't even get a lot of credit cards now. But Affirm and some of these other companies are saying, wait a second, we have all these other signals now that we can use to price credit that's not based on some arbitrary credit score. We're going to use that to determine if we're going to extend you credit.
So that's where I start to get freaked out from a privacy angle. Like, what data are they using?
I mean, to be honest,
looking at your Twitter feed?
They may ask you your income.
Oh, okay.
If you have a steady job. I have no idea. I'm guessing. I've just started doing like research into this, because at first I was very skeptical. I was like, I'm not buying Affirm at a $17 billion valuation or whatever it was. And I don't know. Like I said, I thought it was more a feature that other financial institutions could come up with themselves, or even retailers coming up with it themselves. So I'm digging into that. Now, I will say that I saw that Catapult, what you end up paying, you actually end up paying, if you follow through with the whole plan, you pay double what the product was. So,
over how many installments?
I think it's, you can choose between 90 days to, I think, 120 days or something.
See, I mean, if you look at that as on an APR basis, though, that's crazy high.
Oh, for sure.
Yes. And so that's subprime,
that's
right?
That's a subprime segment, yeah.
I don't know. Maybe they are better off using a credit card versus using Catapult. I don't know.
Yeah.
But I'm sure that they have some way of asking certain qualifying questions to be able to figure out if they should lend to them.
Yeah, and they will ask about employment income and stuff like that, but they'll also look at social scores. They'll look at there's a lot of different data sources. I'll have to go back and look exactly at what a firm has said that they'll look at. But
if anyone in here has actually used any of these products,
we gotta go actually use these products.
Maybe pop in chat. Like, what was the process like? What did you have to tell them or give them?
And Afterpay is pretty interesting, because a couple of the other buy now pay laters are interesting in that it's like Quad Pay is another one, right? This Apple Pay, it's like 4 installments, so it's you pay it off in a month, and you get rewarded for paying stuff off. And so over time, the more you use them, the more benefits you get and things like that, and the more flexibility. There are even some that are now reporting your positive payment history to credit scoring agencies, because a lot of the buy now pay laters, they actually don't report your stuff to a credit agency, which some people like, but other people want to build their credit through these. So it's interesting. But like Afterpay, you can go buy like $100 shirt on a fashion website and just pay off, $25 a week for 4 weeks. And so it's a short-term, very low fee type of option. That's why I said earlier, a lot of people just use it to manage cash flow or to be able to get credit without having to use high interest credit cards.
So what's like a prime rate then on that? Like if you do like 3 or 4 installments, your credit's good. Like
the typical fee is not borne by the consumer. It's actually borne by the merchant. So the consumer is typically not charged anything. The way that the buy now pay later people are making money is they're actually saying to the merchant, hey, incorporate buy now pay later on your checkout page or offer to your consumers. We're going to take 4 to 6% of the transaction as a fee. And in return, you're going to get access to all these customers who can buy your stuff, and we're going to pay you up front. but you don't have to take the credit risk.
Oh, okay. So a firm is taking the credit risk. The merchant's getting paid in full no matter what.
Yeah. So let's use an example like a firm is partnered with Peloton.
Yeah.
So if you want to go buy a $2,500 Peloton bike, but you don't want to pay it all up front, Peloton loves the fact that you can use a firm. A firm's taking the credit risk. A firm will pay Peloton the $2,500 minus a 6% fee, and then a firm goes and deals with the buyer of the bike. And the buyer of the bike just ends up paying a firm payments over time.
Yeah.
And I don't believe there's really any fees on that for the consumer. So,
dude, this could be huge margin compression for credit card companies, right? Mm-hmm. Let's look at...
except that the buy now, pay later companies are basically charging a slightly higher fee than the credit card companies are.
Right. But... So looking at U.S. credit card debt, it topped out... a few quarters ago or a couple of years ago. How long was this? Topped out in, basically end of 2019. And we are currently about 15 to 20% off of all-time highs of credit card debt. So it's actually been coming down quite a bit. Probably some of this is from the stimulus. But yeah, what are the implications if this becomes a more popular way of financing over credit cards? Does this actually crush Visa and MasterCard?
I think it threatens them for sure at some level. Like, you're still going to have a segment of the population that uses credit cards for the reward points, or they use them because they have access to credit, and they want those credit lines open.
Yeah.
But yeah, I think the buy now, pay later space definitely takes share over time, especially because it's the youngest consumers that are really the big users of buy now, pay later, at least initially. So as they age through it, they're going to be more familiar and have relationships with buy now, pay later providers, and maybe they don't decide to take on credit cards from Visa and MasterCard.
Yeah.
So I think it's a threat, and I think that, that's why the Square deal for Afterpay is so interesting. Even though it's a really high price, Square looks at this from a couple of different strategic standpoints. They go, okay, we can actually not only integrate this and offer it for all our merchants on our Square platform, which is great. It also gives us access to all these international merchants we don't have relationships with yet. And third, we could use this as a platform essentially to have a credit card type of functionality or a credit type of functionality for our Cash App users, but it's not a traditional credit card with 30% APRs, and so they're not going to be mad at us.
Yeah.
We're doing our consumers a favor by offering them these buy now, pay later options. So
interesting.
Square makes an interesting play here, strategic, very smart, and I think you're going to have to see companies like Visa make acquisitions of buy now, pay later, or build the buy now, pay later functionality.
Interesting. Somebody just said, the Budget Hustlers just said, someone bought something from eBay from me using one of these buy now, pay later things. It was interesting. The only reason I knew was because they told me. So they didn't even know. Mm-hmm. That's kind of interesting.
That's the idea.
Yeah.
It's supposed to be pretty seamless because you're just getting the full amount up front as a merchant.
Yeah.
So.
And it's all been used online for the most part, but it's going to go into physical stores soon too. Buy now, pay later is going to start showing up at the cash register at actual stores. So the size of the market's pretty massive.
Yep.
And I'm pretty bullish overall on pretty much all the publicly traded buy now, pay later companies.
So put on your certified financial planner hat, Nikki. Mm-hmm. And is this good or bad for people's personal finances in the future?
I mean, I think ultimately anything that's going to help people from crushing compounding credit card debt at 30% interest is a good thing. So if this is giving people access to 0% or even 8%, interest on a purchase, that's, I think, a win. Obviously, you have to be responsible no matter what. If you're doing any type of installment or payments or taking out any kind of loans, you're always going to need to have some responsibility there. But I think this is a win for the consumer overall.
Yeah. Makes sense.
Now, when you look at something like Catapult, you want to be careful because, you just want to make sure whatever whatever program or installment plan you're doing, think about, okay, is this truly zero interest? Is this truly low interest, no fee, etc.? Because if you end up buying something and you have lower credit through something like Catapult, you may be no better off.
Yeah.
Really. So but then again, you know, they offer you the option to return the product. So like say you can't pay for it anymore, you can at least return the product.
Really?
Yeah. So
and have the debt wiped out?
Well, I believe the payments just stop once you return the product, but I'm not sure. I'd have to double check that. But it's giving the consumer more optionality here, you know, and you can also pay it off quicker and completely. It's giving you more choice.
Yeah.
And yeah, you can do that with credit cards. You can pay it off quicker, but you can't send the product back, you know, and stop payments on the product. So yeah, I think it's a win probably.
Yeah. I mean, there is a lot of room for disruption. We've talked about this, about how I'm actually kind of bearish on like travel rewards programs. Like that is extra bloat that's going to go away, right? Like that's not free money they're giving you out of the goodness of their heart. So
it's not.
I think that'll get competed away within the next decade.
Yeah,
we'll see.
Man, it's a fun time to be in the finance space right now because so much is changing and. Yeah, I think that the democratization of finance is happening, and I think overall, you know, consumers are going to be more educated. They're going to have more you know, access to better options when it comes to making big purchases, and I don't know. I think it's a good thing.
Yeah, I mean, there's so much changing. A lot of people are getting introduced to crypto for the first time over the past couple of years, and. Well, I just love all this stuff. All right, let's move on, and then we'll get into some Q&A for you guys. Looks like, you know, obviously travel this summer has been, it looked like it was rebounding, and then Delta hit, but Uber ridership is back up from the lows. I know the FAA numbers are back up. Anything you guys want to say about the travel space? I just figured I'd bring this up because...
I mean, I actually was starting to think maybe... First of all, there's definitely a demand for travel right now. I think even airlines are like, can't keep up. Didn't Spirit Airlines, like, they didn't have enough labor or something?
I know American was short on pilots. Yeah, it's a cluster,
yeah. I mean, we even were trying to go out to eat, you know, when we were gone, and it's like impossible to get good service these days because there's no labor.
Yeah.
So, like, people are out, they're traveling, they want to do this. So I'm actually, you know, pretty bullish overall on that, but obviously there are a lot of things happening right now, and you know the variant is causing a little bit of chaos, and I think that may we were you know heading on our way up, and now we might be coming back down a little bit. I think I actually saw a stat that credit card transactions have gone down in the past week because of what's going on with the variant.
And the travel stocks have definitely taken a hit, but it's so interesting, like you said, because you're seeing the airlines reporting their Q2 numbers above expectations. Wynn Resorts reported numbers above expectations and basically said that the back half of the year is set up to be one of the strongest performances in Vegas they have ever seen.
Wow.
And their hotels are just absolutely packed. And you've got, I think TripAdvisor reported today, I think I haven't had a chance to dig into their numbers too much, but it looked like they beat earnings estimates. So you've got them all reporting great numbers and being optimistic about the balance of the year. And yet you have the stocks pulling back because of the Delta fears and what that might mean for, you know, further restrictions. But this might be honestly a buying opportunity in some of these stocks.
That's what I was trying to get to. Yeah. I think that there could be something there with these travel stocks.
All right, which ones are we buying?
I mean, look, eventually this is going to pass, and people are going to go back to wanting to get out. And hopefully there's enough labor to where they can, you know, the economy can support all of the flights we need to take and all the restaurants we need to eat at, and, you know, hopefully that all comes back and works for us. But
yeah, I mean, obviously last March was a great buying opportunity. If you would have bought Warren Buffett's airline bags. But yeah, I mean, things are pulling back. So you guys are looking at travel stocks again as potential buys here? Okay.
I think I am. Maybe.
Okay. I guess on the other side of that coin, so travel's the fun part, but we've got the battles now heating up over the eviction moratoriums. I know that officially ended federally last week, right?
July 31st.
July 31st. And then, so now it's up to the states to continue that. Is that right?
Biden is calling on the states to issue their own extensions and get the federal money out quicker. That's been the problem. The states have access to billions of dollars of aid, renter's aid and landlord aid, but it has not been being distributed at the speed that it needs to be.
Yeah.
Half the people don't even know how the hell to even figure out how to sign up for it. So there is aid out there for people that are behind on rent and landlords that aren't getting paid. It's just the states have to get it together, and they've got to get that money out there.
Yeah.
So I know that there's basically a fight right now going on between the CDC and their actual legal ability to extend the eviction moratorium, and then they basically don't have the authority now. They need legislation to actually be able to do it. So there's that fight.
Yeah, what a mess.
So some people actually ended up getting evicted. I was reading an article about this in Houston. There was like a 2-day window where it was a free-for-all for evictions, and some people actually ended up going to court and getting evicted in like that 2-day period.
Wow.
So I don't know. The states just have to get that money out because it's there. I mean, that's my understanding of it.
Yeah, it's such a mess because obviously you don't want to kick people out that have been affected by COVID, but at the same time, I know personally landlords that are like, I haven't gotten paid in over a year, but I still have to make the mortgage payment. I still have to pay taxes. It's like, I don't know. I feel like if a government's going to mandate that you can't kick a tenant out, then they should step in and actually pay the rent. Otherwise, you got the handcuffs on.
I mean, they allocated the funds to do that.
Yeah, so give them the damn money or let them get a paying tenant.
But it's up to the states to have the process there and make it easy and doable for these people.
Yeah.
Yeah, I mean, property rights is one of the most fundamental things that I think most of the country agrees on here in the U.S. And if you can't, if you've rented your place and someone's not paying for it and you can't kick them out, that seems to go against the fundamental idea of property rights.
Yeah.
Yeah.
I mean, it's like you have a squatter here that you like legally can't kick out.
Yeah.
And it's like you said, obviously we want people that can't pay rent to get help financially, but you don't want it infringing on the property rights broadly of people, of landlords. I mean,
I can't imagine being a landlord right now. Glad I'm not a landlord. I'm sorry if y'all are landlords in here. I just can't imagine. Hopefully you're not having to go through that.
Yeah.
I mean, luckily for landlords, their property values are theoretically up a lot.
Yeah.
So
yeah, no, yeah, there's that.
Yeah.
Man, this whole thing is just a double-edged sword everywhere.
We are living in the upside down, right?
We really are. We have been for a long time now.
It's amazing what happens when you increase the money supply by a quarter in a year.
Oh yeah.
Yeah,
Right.
it's really effed things up.
Let's just, okay, we have a virus. Okay, let's just create more dollars. Let's just create. And then over here, the Bitcoiners are just going, yep, okay, well, we see you. We see what's happening.
Yeah.
All right, we'll stack sats.
The U.S. government is, the largest buy now, pay later
Ponzi scheme in the history of the world. Yes.
They really are. Layaway on steroids.
Yeah. All right. Cool. What was this? One more article, and then we'll get to Q&A. Nikki, was this yours?
What's that?
Yelp now offers a feature that allows businesses to specify if they have vaccine requirements.
Yeah, this is
a hot topic.
Weird. It's getting weird.
Yep.
Yeah, we may not even want to. We may want to brush over this one. Actually,
Let's do it. Let's dive into the pits of hell.
The more that I think about it.
Yeah. Okay, so basically, Yelp is allowing businesses to post what their vaccine requirements are, if any.
Yeah.
Okay.
Yeah. This is the new trend. New York is also starting to require vaccinations for if you're going to go to a restaurant or the gym or a theater.
Yeah.
California is starting to require their some of their government employees to be vaccinated. It's like, I think I just saw on a couple people got fired at CNN for not being vaccinated. Like, it's just getting crazy. And I don't know if this is going to cause an uprising, between people, or
I think it already is.
What that's going to do to the markets.
Yeah.
Like, if that's going to affect the markets at all. But here's one thing. Let's parlay this into the markets, actually. One thing that we have right now is companies in March of 2020 had their hands tied. They had to shut down, and there was no recourse. At least now, companies can stay open. Businesses can stay open. And if they have to have a policy to stay open, at least we have that now that we didn't have in March 2020, which I think the market is probably appreciating. Because, the markets are at all-time highs right now.
Yeah.
I think the NASDAQ broke an all-time high today.
It did. Look at this.
And I think that the S&P is testing resistance for an all-time high breakout.
Yeah.
It's crazy.
I shorted futures a couple weeks ago, so you're welcome.
Trav loves those hedges. Hey, man, one of these days you're going to be right. We're all going to be wishing we had those hedges on.
Is going to actually hedge.
I love my hedges. They help me sleep at night. My portfolio.
One day we're going to wake up and the world's going to melt down around us, and we're going to say, "Damn, we wish we had those."
So all I'm saying is, I guess, love it or hate it, businesses now have some way to stay open.
Yeah. Okay. I'm going to attempt to tackle this. Here's what I think. I believe in private businesses' rights to set whatever standards they want to protect themselves, their employees, and their customers. I think the federal government should stay out of it, stay out of mandating it, and let the businesses take care of it. What do you guys think?
I agree with that. I think that's, again, going back to fundamental principles of what this country, the USA at least, stands for. It's a lot of private property rights and the capitalist system that while there's rules, to some extent, businesses should be able to determine what kind of services and goods they offer. And if they want to say no shoes, no shirt, no service, great. We've always had that. If they want to say vaccine required or mask required, great. They're going to limit their own customer base by doing that, and that's a trade-off that they have to decide if they want to make or not.
Yeah. There was actually a guy, I forget what the business was, but he said no vaccinated people.
Yeah, I saw that, yeah.
So I'm like, okay, that's a weird one, but apparently it got a lot of business for him.
Right.
Yeah.
That's right, yeah.
So,
if
I don't know.
Chick-fil-A wants to stay closed on Sundays like idiots, they're allowed to do it.
Right? Why? Stop it, Chick-fil-A open on a Sunday.
Yes. All right, cool. Well, I guess we shouldn't go any deeper into that. We'll just leave it there.
We should not.
All right. Let's jump back into the charts. Let's jump into some questions.
Robinhood. We still haven't talked about
Robinhood. How did we forget about it? Okay, talk about a funny one.
Did we really expect anything less than volatility from Robinhood?
Right. It was a massive squeeze. So for anybody that doesn't know, Robinhood listed on the 29th of July and promptly sold off from $40 down to 35, and then over the past few days just ripped everybody's faces off, went up to $80 and is now back down to 50. What happened?
Everyone was so convinced on the IPO day that this was going to be a busted IPO.
Yeah.
Even I was like, wow, okay, yeah, this thing's selling off,
Yeah.
And man, did it rip people's faces off in surprise.
Was it a short squeeze or was it just, what was the deal?
It was a gamma squeeze. So two big things happened. The main thing that happened was the day that they listed options for it, you had serious call buying, which caused the market makers to have to buy stock to hedge, and it just sent the stock up. And so what's interesting, right, with IPOs, with traditional IPOs, they typically only list a very small portion of the overall outstanding shares. So you have a low float usually to begin with, and if you can get enough demand buying those shares, or you get market makers who are buying lots of shares because they're hedging for the options positions that are being bought by investors, then you can get a pretty nasty move. And certainly I'm sure there was some piling on and some meme stocking going on, but the spike happened the day that the exchanges listed options for Robinhood. So it was very clear that it was a gamma squeeze.
Yeah.
At least initially.
So it was the options traders.
Yep.
Yeah.
Okay.
Man,
and you had crypto doing well too over the past week, so that probably helped, right?
That helps.
Yeah.
It's incredible to me to see how options are moving these markets.
Yeah.
I don't think I've ever seen anything like it before.
Yeah, and option volumes have been growing massively over the past couple of years, and so this has become definitely more of a mainstream phenomenon. I doubt that many people knew what dynamic hedging or gamma squeezing was 2 or 3 years ago. Now it seems to be all over. I see people writing articles about it now, and so it's definitely on people's radar. It's so wild. I mean, Robinhood, their main revenue source is options.
Yeah,
they make
I saw
more
that.
from options trades than they do stocks or crypto. So
I wonder. Never mind. It's like I wonder how many of those options traders on Robinhood actually truly understand options.
Great question.
I always wonder that because I feel like options are so complex for a newbie.
Well, so to me, this is my opinion. You guys let me know what you think. Options are one of those things where it's very easy to learn the very basics to where you can get yourself into a shit ton of trouble with them, but it's hard to learn enough and to have enough skill in the market to be able to use them effectively and actually be consistently profitable.
Yes. I've been utilizing options for the better part of 15 or 20 years in my investing, and there's still a lot that I don't understand. And, I've read Taleb's book on dynamic hedging. I sat on derivatives desk at Goldman Sachs with the smartest derivatives traders in the world. And there's still a lot of stuff that I don't fully understand about, option strategies and things like that. I would say I'm, probably intermediate to early advanced, but after 15 years, 20 years, there's still a lot I don't know.
There's no hope for me then.
I just love the spot markets, man. After trading futures for so long, I'm like, the spot markets are beautiful because you can't get margin called. You can manage your bankroll effectively. Like, yeah,
Boring.
I know. I can hear people falling asleep right now, but
I'm just kidding.
But I made millions in the spot market.
I agree. 1,000%.
There's that.
I do enjoy the options from time to time.
Yeah.
I do dabble.
Hell yeah.
I do too. And it's almost more for fun than anything else because I've messed up the duration of my trades trying to do options instead of spot before. Like GME, perfect example.
Yeah.
I was buying shorter term calls. We called the squeeze at $4 a share, but I didn't really participate in the rise from $20 a share to $200, $300 a share because my options had expired. So I messed up the duration of my trade by trying to get ultra leverage with short-term calls, and I would have been fine if I just played it through, more stocks.
That's the thing is like the gains on calling it in a shorter period of time are exponentially better. Even if you get the right call, if you're a little off on the time by a month or two, it's like the difference in gains is by a factor.
Or even a couple of days.
Yeah.
It could like gap up a couple of days after your call expires.
True. But like say you do like a 30-day versus like a leap, it's like night and day on the returns. I don't know. I'm not smart enough to make sense of it. And if you aren't even super confident in them, I'm like, well, let me just stick to what I know.
Don't worry, I'll handle the options trading.
Get her done, Nick. All right, guys, let's jump into some Q&A. I think we've been going about an hour. Nick, I think you had some questions that were submitted earlier, right?
Yes. So I got 2 questions.
Okay.
Actually, maybe more than 2. One that we got was, where are the banks, and this is from Steven. Hi, Steven. Where are the banks getting the money that they're putting into the reverse repo market? Is it profits they have made or client money? Where's the repo money coming from? Or is it reverse repo? Where's the reverse repo money
And
coming
maybe
from?
explain what that market is for anybody that doesn't know, too.
Yeah, that's a great question. I mean, I don't pretend to fully understand every detail about the reverse repo markets or the repo markets, but the participants in the repo markets are money market funds and banks, and then on the other side, the Fed. So the Fed has essentially said, if you've got excess capital that you can't go invest in treasuries because there's not enough treasuries, and you've got essentially banks and money market funds have all of this money that is technically owned by corporations and individuals, and this is companies and individuals' money, but it's sitting in bank accounts, it's sitting in money market accounts, and that is essentially a liability for banks and money market funds. But it's sitting there and they're managing it, and they want to earn at least some return on it while it's sitting there and not being used. And they can't all go put it in treasuries, especially short-term treasuries, because there's just not enough of them because the Fed's been buying them, at least short-term treasuries, right? So the Fed has a program called the reverse repo program where they go and they give, they give these deposits to the Fed, and the Fed will pay a little bit of interest to them, and that's essentially what the reverse repo is. So it's the reason that we have $1 trillion of reverse repo money is because there is a glut of savings and money market funds out there right now because of the high savings rate, the pandemic funds, all of the fiscal stimulus money that's still sitting on balance sheets. Essentially, it's not being loaned out. It's not being spent quickly enough. So it's just sitting there in all these accounts.
So step one, money printer goes burr.
Yeah.
Step two, money sits in banks, and banks got to figure out something to do with it.
Yep.
And then step three, this is where we are.
That's right.
And then the Fed has to pay interest on the money printer that they made go burr.
See, I can even understand that. Even somebody like me can get that.
Yeah. And those are the basics. There's a lot of details, but and there's all these conspiracy theories about what this reverse repo means and why this money is going to end up flowing into some other thing. But it went from people were worried about it when it was 300 billion, then they were worried when it was 500 billion, then they were worried when it was $1 trillion. The answer is it doesn't really matter. This is a pretty normal operation that the Fed is conducting, and it could go to 2 trillion or 3 trillion, and it's not going to crash the financial system per se. What will be interesting is when this money starts to flow out of the reverse repo facility and actually get spent in the real economy. And does that create more structural inflation? Does it create asset bubbles, et cetera? That's really where it gets interesting, I think, personally.
Travel stocks go burr when that happens. Maybe.
Yeah.
Awesome. Well, thanks for the explanation for us plebs.
Yeah, of course. Oh, and there's a good blog, I think it's fedguy.com. Some of his writing is a bit wonky. It's definitely out there and detailed, but he is a former, I believe he used to work at the Fed, and I don't know why they're anonymous, but they write a blog, and it explains a lot of the money market operations and stuff. It's interesting.
Cool.
Outlier said fiat needs a white paper.
There is no white paper.
I agree.
Yeah, what it is it's going to change every 4 years or every cycle, and it's at the whims of people.
They're going to come up with these new rules, like buying muni bonds or whatever the heck they did.
Yeah, it's basically like an experiment that has no end. There is no succinct white paper that you can read and understand and go, I trust that. That makes sense. Yeah. All right. Next question.
Okay. Next question came from Fight Fire with Fire, who I actually got this question from my Instagram Live this past week, but I couldn't answer it.
Okay.
So, given the current and future interest rate environment, do you think bonds still have a significant role in portfolio construction? I have my answer to this, and Trav, I'd love to hear your answer.
So are we talking government bonds, corporate bonds? I guess that's kind of the question, too.
It's probably like the whole 60-40 thing, right?
It wasn't specified, but yeah, generally just...
60-40 is kind of dead. If you're trying to use bonds to hedge a stock portfolio, unfortunately, the correlations are not what they used to be. 60-40 got popularized because you could essentially have 60% stocks, 40% bonds, and the bonds would protect you when the equity markets crashed, et cetera. That might still be partially true, but the correlations have changed. Also, you're not really getting paid that high of a rate of interest. And so the question is, at these ultra low rates, what is the upside of holding bonds in the portfolio? Maybe you could leverage your bond portfolio to give you a higher rate, but then there's risk there. So I think there was actually someone from Bridgewater on the Invest Like the Best podcast a week or two ago.
Yeah.
And she talked about this a good amount. She can explain that much better than I could. But even Bridgewater, who has kind of pioneered the risk parity portfolio of using stocks and bonds as hedges in a portfolio, even they're kind of figuring out how do they diversify their portfolios outside of the traditional stocks, bonds. They're also now looking at crypto, gold, other ways to use less correlated assets to hedge an overall stock portfolio. So I would say 60-40 is not what it used to be. And bonds are risky here. I truly believe when you're getting negative real yields, that it's kind of a sucker's game to me. And I just wouldn't want to own 10, 20, 30-year treasuries at rates that are losing purchasing power to inflation. That's me personally, but I know that there are reasons why some institutions out there want to own bonds at these types of rates, or they believe that they're still going to be a good hedge, or whatever the reason that they're buying them here is. But I don't see why you would have a large allocation to treasuries yielding less than the rate of inflation.
Yeah. I agree. I think bonds are a tough place right now. And I would say if you are going into your retirement years, you know, you may not want to be 100% equities and crypto, you know, so bonds may be the only place for you to hold some purchasing power or keep your capital at least somewhat less volatile. You know, you be losing money to inflation, obviously, in the end, but it's kind of one of the only places you can go once you get there. But I think that if you're young, bonds have lost a lot of their appeal right now, especially with pretty much, I don't want to say it's a guarantee that interest rates are going to rise, because it's not, but the Fed is going that direction. Inflation is going that direction. So I imagine eventually we will see interest rates rise. And when that happens, bonds are kind of screwed, so to speak. So wait till the rates go higher and then maybe buy those bonds that are yielding more. Not saying eventually bonds may not be useless forever here. In the future, they could end up looking attractive again. But
so I think what I hear you guys saying is, say it with me, 1, 2, 3, buy Bitcoin.
yeah, I mean, it really depends where you're at in your life too, you know, because hey, being 70 with an equities portfolio and bonds and gold, that's a bit volatile for somebody.
Absolutely.
Know?
I mean, look, if I was 70 and I was trying to live off of like the 4% safe withdrawal rate, the thought of being in Bitcoin, even though I'm a Bitcoin bull, scares the shit out of me, because I'm like, oh, I could have an 80% drawdown, and then all of a sudden I have to stop eating meat and only eat, you know, vegetables, which I'm a meat eater, you know, like stuff like that. Like that would be weird.
And then bonds there kind of work because you can kind of keep your capital somewhat there and you're earning some yield. It's not a lot of yield, but you're earning something. Yeah. So I don't know. If you're young, I don't know if I'd be buying bonds too much right now.
Yeah. I don't know. It's a weird time. If I were 20 years old, I would take all my free cash flow and put it into, this is just me, nobody do this, I'm not your financial advisor, this is what I would do. I would put it into value plays, like the stocks that you guys look for. I would stack Bitcoin and Ethereum and whatever cryptos you like on a monthly basis. If you want to trade and be strategic with entries and exits, yeah, you can juice returns doing that. And then I would take every spare penny and put it into a cash flowing business, or I could just make more and more monthly cash flow to feed the machine. That's what I would do.
Well, to be honest with you, I think that big tech is becoming the new bond in a way.
Ooh.
You know, I think that a lot of allocators or portfolio managers are allocating a lot of that bond money into dividend paying high quality stocks and big tech, because big tech's kind of like, hey, it's it's never a sure thing, but they're looking at it and they're like, shoot, interest rates are probably going to go up, inflation's going up, why am I going to allocate to bonds right now? I'm just going to allocate to big tech. And
as
high
evil as
payers.
some of them are, it makes sense. I mean, they've just got so much leverage.
It's kind of like the safe play right now. It's less volatile, you know, generally.
That freaks me out when you say that, though. The safe play, like when I look at the Nasdaq.
I'm not like, look, I know it sounds crazy, but big tech is kind of being seen right now as the safe play versus like putting a bunch of money in bonds.
Yeah, I don't know, Trav. Come on, bring us back to earth here.
I don't know. Yeah, maybe I mean, that's.
Yeah, we're all between a rock and a hard place. Honestly, I agree with you, because even though we're at historically expensive levels in U.S. stocks, the argument to be made is still that the equity free cash flow yields or earnings yields still look pretty good relative to these ultra low rates and ultra low real rates. So what I mean by that is, like, if you take the earnings or the cash flow of companies versus the market caps of those companies, we call that the earnings or the free cash flow yield. Even on big tech stocks like Google and Apple that are at high PE ratios, their earnings yields are still like 5%, maybe 4%. And that relative to, especially if you expect those earnings to grow over time, that relative to, you know, a 1% 10-year bond rate still looks pretty good.
And they're growing still at 40% revenues.
Yeah, I mean, Google earnings the other day, Apple earnings the other day look great, right? So, so that's the argument for why PE ratios could still go to like, 40, 50 times on some of these stocks. And, you should be compensated. I mean, you are taking greater risk with stocks, and so it should always have a higher yield than government bonds. But the question is, what is that difference? And right now, the difference is still pretty fat. So like you could argue that stocks have still room to move higher. Now, what I choose to do is I try to look for stocks that have even higher yield, or the potential for even higher free cash flow yields in the near future. And you could also even maybe go look at some international stocks that have even lower PE ratios, so that the gap between the earnings yield and the bond yields are even higher. So you're not buying super expensive stocks, you're still buying relatively cheap stocks, something like that.
Yeah.
Yeah.
Well said. All right, next question. Fran was asking, yield farming or trade spot in the current market? So basically take capital and put it in some kind of yield farming situation, or just trade spot. I think the answer depends on your risk tolerance. It's like, and your technical sophistication. Like, do you understand how to go into the DeFi space and not get rug pulled, not get your wallet strained, and understand principal risk, right? Like, a lot of people that were crushing it at the all-time highs with the yield farming stuff are now taking massive drawdowns in their portfolios. So you've got to understand what happens to that yield when prices fall. And look, I'll just tell you what I'm doing. I am mostly spot. I am mostly a position trader and a swing trader. I don't day trade unless it's like the occasional fast move, but I'm going for like multi-week, multi-month moves. And then I'm trading the larger multi-year market cycles. That's how I make my money. I've dabbled in the yield farming stuff. I have friends that make a lot of money in that, but they also have really, really big drawdowns, and they've gotten rug pulled, and like there's principal risk there. So it's totally up to your own risk tolerance. I can just tell you what I do and what I've seen other people do successfully. And I don't know. The yield farming stuff is absolutely the future in some capacity, but it's not a risk-free yield. A lot of people go, oh, I'm going to make 1,000% a month on this thing. You either get rugged, you get compression of yield. There's so many different things that can happen. It's not a guarantee. So you've got to decide that for yourself.
Tristan was asking earlier about SPAC stocks like Matterport, SoFi, Lucid. Yeah, we've got a growing list of completed SPAC deals now. We still have a lot that have announced deals and haven't completed, and obviously still a lot that are pre-deal. But the completed SPAC universe is growing, and that's going to offer a lot of opportunities. You asked about Matterport, SoFi, Lucid. Lucid's an interesting one. I'd be worried about Lucid in the next 1 to 2 months because the lockup is going to expire there. So you're going to have a lot of hedge funds that participated in the pipe at $15 a share that are sitting on paper profits with the stock trading in the 20s. They could unload a lot of stock in the month of September. So I'd be a little bit wary of that one, and they still have a lot to prove from a business model perspective. Matterport's actually been performing pretty well. That's an intriguing business. I don't know enough about it yet to really give a strong opinion one way or the other. I've seen bear and bull case on that one. I think it's going to be a battleground stock for a while, but they're definitely doing some interesting stuff. What's the other one? SoFi?
SoFi.
I think you've taken a deeper look at SoFi, right?
Yeah, I have. I was interested in it at one point, but now I think that SoFi could be interesting to me if it comes down more. I really want to get it cheap. I'm not buying it here. What
are you thinking?
I mean, I was thinking maybe if it came down into the $10 to $12 range, I would nibble at it. Mm-hmm. I'd have to double check. I haven't looked at it.
That's just based on valuation, or?
Yeah, I'd have to look at that again to figure out exactly the valuation specifically. But I think that they have the asset. I forget the name of it.
Is it Galileo?
Galileo. I forget the name of it every single time. Galileo essentially they acquired Galileo, and that's kind of more what I'm interested in than anything.
What does Galileo do?
Galileo, they allow different fintech companies to offer debit cards. So like Robinhood and Chime and all of these different companies that come in, Dave, there are different fintech apps that they offer their own cards. And there are two main people in this business doing that, and it's Galileo and Marqeta. Marqeta, last time I looked, had like a $14 billion valuation. I think SoFi was somewhere around $17 billion. So I haven't looked at Marqeta in a while, but what I was thinking was the asset of Galileo that SoFi owns alone, maybe there's like maybe there's something there that the market is maybe not accounting for in that business, and the business, that specific part of the business, is growing pretty well. And as far as I know, I don't, I'm still trying to figure out the ecosystem if there's disruption there. But SoFi is an interesting company to me on the actual core business side of the lending and the investing and all of the different financial services that they're offering. It's interesting to me because millennials have shifted their perception of banks. They hate traditional banks. They hate Wells Fargo. Yeah. They hate Chase. They hate Bank of America, and they don't trust them. So SoFi is interesting to me because they're coming around and building this brand around trust, around financial literacy and teaching people, and that's how they're trying to build their user base. And love them or hate them, I think that there could be something there. So between that and the shift in consumer behavior and tastes of millennials, who are these up and coming, people that are going to be accumulating all of this wealth, and then that asset of Galileo that they have within the business, there could be something there at the right valuation, I think. Sorry, cool. That was a long-winded answer, but...
Love it. Trav, any thoughts on that?
Yeah, I just wanted to, not on SoFi, I think that was a really good breakdown of the situation, but I just want to say quickly on the SPAC side of the fence, there's been some interesting trends that I want to call out. SPACs have been really underperforming. A lot of them have been selling off post-deal lately, and we also saw a couple of high-profile SPACs like already reduce their guidance. A lot of these SPACs came out with high valuations and these rosy forecasts for the next 5 years. I believe it was ATI Physical Therapy. ATIP was down like, what was it? I think, well, it's down about 60% from its deal price, but it announced already that it had just de-SPAC'd not that long ago. It announced that they were going to take guidance down, that their numbers weren't going to be as good as they had said just a month or two ago. So that one got whacked. You've seen even some high flyer SPACs like Desktop Metal and a few of the other ones that were previously pretty high have gotten whacked. Hippo Insurance today down 17%. So you're seeing a lot of de-SPACs quickly trade below 10 and then get pummeled down to like the $7-8 range. Talkspace was another one that got hit. So I see them as potential risks right after the de-SPAC, especially if they've got a lot of fast money hedge funds that participated in the pipe and they're able to start selling their shares. Arbitragers as well. There's going to be a big bifurcation between like the really good companies done at good valuations, the good deals versus the bad deals. And I think you have to be especially tuned to what these businesses are doing in the short run, because you could lose money pretty quick on these de-SPACs. So I think you have to do really good due diligence, and really only if you're betting on SPACs post-deal, you really got to be betting on the ones where the deal sponsor has their incentives aligned, the valuation is reasonable. I'll give you an example where I think one, we've talked about it, I believe in the past, MUDS, Mudrick Capital Acquisition, is taking Tops public. And that's one where it's still trading around the deal price. It hasn't completed the deal yet, but that's one that I think has potential upside. The valuation was reasonable. They're buying a business that has a lot of optionality, Tops in NFTs, I think, and that's why it initially spiked. I think this has the potential to have some longer term upside. The core collectibles business is probably worth what they're paying for it today. So that would be one where I think there's some intriguing opportunities there to own it for a longer term play.
Trev, real quick, can we talk about, like, for anybody that doesn't know how the SPAC pricing works and what why the $10 mark is so important?
Yeah.
Because some people look at this and they're like, oh, this is just a stock chart and it has support at 10, but no, that $10 price point is important for a reason.
Yeah. Yeah. So it's a technical and psychological level. So from a technical perspective, most SPACs, before they have a deal, they raise at $10 per share. And for whatever reason, that's just what SPACs started doing. And most of them follow that. I believe Pershing Square was the only one who didn't, and they raised at $20 a share. But every other SPAC pretty much raises their initial capital at $10 a share. And whatever number of shares they have determines the amount of capital they get. But because they're at $10 a share, what happens is in typical SPAC transaction, they'll go and look for a deal. When they find a deal, they'll announce the deal, and then it takes them a couple months to close the deal. When they close the deal, then once it's the company that's been acquired, it can kind of trade to whatever valuation the investors think that is worth. But at the deal confirmation stage, so you have all these arbitrageurs and investors that are able to buy the stock, and they can actually redeem their shares for the original $10 per share price plus a little bit of interest if they want to vote the deal down and just get cash back. So some investors choose, especially if the stock's trading below 10 prior to the deal closing, they can say, I don't want shares in this new company that the SPAC is acquiring. I just want my cash plus a little bit of interest back. So a stock pre-deal can't trade that far below $10 because it would essentially be free money for them. If the stock went before the deal closed to like $5, you could buy it at $5 and then redeem it for 10 from the SPAC sponsor before the deal closes, and you'd have a massive return. So there's all these arbitrageurs that ensure that that can't happen.
Yeah.
So you'll see some SPACs trade down to $9.75, $9.80, but that's kind of the floor, at least before the deal's completed. Now, once the deal is completed, like I said, it can trade anywhere. But if it breaks 10, what happens is, and especially post-deal, if it breaks 10, a lot of investors don't want to lose money. Their stops get hit, and the arbitrageurs will be selling too. And so it can have a fast waterfall down. I know this is kind of confusing, but at the end of the day...
No, I think it makes sense. So basically, you raise money at $10. That's what the fund is worth, right?
That's what the SPAC is worth.
That's what the SPAC is worth. And then was this rumor of the deal on Talkspace when it first went up, or was this
I think that was actually initially when the deal was announced, but not closed. So
the deal was announced. People were like, "Oh, this deal is coming down the pipeline." So people started buying in anticipation of that.
Yeah.
Drove it up to over $12, and then it came back to 10. And then once the deal was finalized and actually started working, people were like, "Oh, this doesn't look too rosy. It's going to lose money." And then boom, we're down at $5.
Yep. So this is actually a perfect example of a fairly typical SPAC pattern over the last few months. You can have some initial enthusiasm when the deal is announced, but again, it takes a couple months for the deal to get actually finalized and completed. What happened with this one, enthusiasm, but then it sold off. And the $10 level has this magnet. Before the deal closes, it's a magnet because there are these arbitrageurs who will buy it when it dips below 10 because they know they can redeem their shares at 10. You know, they can vote down the deal and get their $10 plus a little bit of interest back. So you have arbitrageurs setting the floor, but that also means if it rises too far above 10, those arbitrageurs will sell the stock back.
Yeah.
They'll be like, well, I won't redeem, but I'll just sell it in the market for more than 10. So it becomes this magnet around 10. So you don't know in situations like this, once the deal is completed, is it going to trade back above 10 or is it going to trade below? We've seen some that will trade above 10 and go up and do well, like Matterport. I believe MTTR is the ticker on that one. It actually turned out that there are buyers of the stock, post-deal. It's kind of like having a hot IPO. Like, people are excited about it still, so they're buying it. It's at $15. But with Talkspace, the one you were showing before that, it actually turned out that it broke that $10 level right after the deal was completed, and there were not many buyers, and did the thing waterfall to $5 or $6 pretty quick.
Are these shortable?
Sometimes, yes.
Okay. Because it seems to me like that would be a good play, right? It's like if 10 is the line in the sand and the deal's kind of falling apart, you can kind of front run the short waterfall.
Absolutely.
That'd be kind of sweet.
Yeah, and borrows are a little bit tight because some of the float is thin on these.
Yeah.
But yeah, some funds have started shorting these like prior to the deal being completed or right after the deal completion. So that's again why I said earlier, you got to be really careful because these things can trade down really quick. Now, again, that for us, that also offers opportunity because there's SPACs that may trade down to $7, $8 quickly that don't deserve to be at $7 or $8. And it's weird because IPOs, when you look at traditional IPOs, they've been pretty strong this year. Most IPOs have traded above their IPO price, have done pretty well. I mean, look at Robinhood earlier that we were just looking at.
Yeah.
These low float recent IPOs have been doing pretty well, but SPACs have been doing kind of poorly. So I think at some point there's going to be maybe another positive SPAC cycle where you have some of these low float SPACs, people realize they can actually squeeze them. And you'll have the opposite of what's happening now with these down waterfalls. You might have some short squeezes again in SPACs at some point.
Yeah.
Do you think it's going to take a couple of rounds of earnings for some of these?
Yes. And I think that'll be the key. You need some quality post-deal SPACs to really start putting up good numbers and start squeezing, and then people will be like, oh, not all SPACs are dog shit.
Yeah. So, man, it's such a fun time in the SPAC world to either go hunting for shit that got destroyed below 10 or to catch the squeeze before it really happens above 10.
Yeah.
I don't know. It's fun. It's a fun game to try to figure out.
Yeah, a lot of complexity here. You know, if you join our We Talk Money or our Skill Incubator wealth building community, we are actively hunting opportunities in SPACs. So we've got some plays, and you know,
Talkspace is advertising a lot. I've been seeing their I don't know if it's because I like look up, do research on it or something. Maybe that's what it is. I'm getting flooded with ads.
Yeah, they're retargeting you probably.
They must be retargeting me. I'm like, man, they're doing a lot of marketing right now. But,
well, that's awesome, man. Thanks for sharing that. I know, you know, for some people that was probably a lot to take in, but it is one of those kind of new niches of the market that if you understand, there's a lot of alpha there.
Absolutely.
Like you can make a lot of money. It's kind of like, you know, alts in the early days, or even, you know, newer alts that are coming around all the time. So
I love how Robert Lyons has written "smash the like button" in all caps. Thank you. Thank you, Robert.
I'm like the worst YouTuber ever now.
Will you tell people to smash the like button?
Let me do my what's the face? Oh, we got to do the cover images. Oh shit, something crazy's happening. Smash the like button. Yeah, what else?
Do it. Hype yourself up.
Does that work?
I don't know.
Subscribe.
I can't.
Does it work now? Like, because every YouTuber now does the smash the like button. Does it still work?
I don't know. I don't know. Y'all tell us.
But check. So, you know, when we were on our trip, I was thinking, you know, when we were hiking, I'm like, I haven't really done like regular YouTube videos in a long time. And I was like, I'm just curious if anybody actually wants me to do these. So I tweeted, I said, I'm thinking about doing some short form YouTube videos again, but I've been disgusted with most of the crypto YouTube content over the past few years. And I should clarify this, but what I said was, should I do it? What types of videos should I do? And I got a lot of really good recommendations. So I'm probably going to start doing some again. I just don't want to be like one of the YouTubers. Like, there's so much cringe out there. I think what I'm going to do is just like pop my phone up and just start talking about shit. I don't know. We'll see. I'm going to test it. If you guys want me to do more videos, let me know. I'm disgusted with both YouTube as a platform and also most crypto YouTubers today. So I don't know. Other YouTubers they shouldn't impact what I do.
No.
But I'm so grossed out by the space. You know, there's so many people getting paid to do shills and just a lot of nasty stuff that I see. I don't want to be a part of that anymore.
But you can be that shining light that goes its own way.
I guess so. I don't know.
Its own way. People know that you're not full of BS.
Yeah.
You know,
it's just, as the grandfather of crypto YouTube videos, as the first guy in the world doing them, I'm like, do I really want to even be in this? But I just want to talk about investing and like help our community. But I guess the way to do that is to do content that gets a lot of views. That way we can get the eyeballs off of the scammers and the frauds. And, so
someone's got to do it.
Yeah, it's called the blow face. Yeah, I don't know. Oh my God, I
want to start just like making NFTs that are like defacing those thumbnails, like putting weird things in those people's mouths, or you know, just like.
Oh man.
See, Kirkus said that's why we watch you, Chris. Quality.
Yeah. That's what we got to do. Chris Dunn on TikTok. Hail to the no. Oh, sorry. I'm never getting on TikTok. Love you guys. Awesome. I saw a couple more questions. I know we're going kind of long right now. Somebody was asking about strategy for dollar cost averaging. Where do I buy it, etc. Yeah. So for anybody who's new, just go to any like listing website like Masari.io here. Look at, you know, the top cryptos by market cap and go to markets tab and you'll see the exchanges where you could actually buy and then sort by real volume over the past 24 hours and just see which of these exchanges you can sign up with. You don't need a broker. You don't need a middleman. With crypto, you can go direct to an exchange, which means it's kind of like the broker is the exchange in a way, but be careful giving your money to anybody who's not one of these massive exchanges, because they'll take it and you'll never see it again. But yeah, I hope that makes sense. It's very, very easy to buy on the spot markets. Just sign up. Unfortunately, you got to do KYC with most of these, but it's a necessary evil for quality centralized exchanges. Once you get some crypto, then you can go to decentralized exchanges, Uniswap, Sushi, all that stuff, and go down the rabbit hole to never emerge, and you will be a crypto fiend for the rest of your life. And welcome. Welcome to the community. Welcome to the red pill. It's the red pill, right?
I don't know.
Allegedly.
I think
Okay, we'll see. Red pill, blue pill. You're going to go down the crypto rabbit hole, and you will really start to rethink a lot of the things in your life. Yeah. All right.
And
well,
as far as dollar cost averaging, just real quick.
oh yeah,
on
I forgot that part.
Yeah, I mean
yeah.
that is pretty much whatever asset. It's kind of the similar idea is that, especially if you're earlier on in the phase of your life, you know, you can not worry as much about trying to pick an exact point. If you're trying to get a longer term holding, just put a little bit in every month and don't worry too much about trying to like get too tricky with timing. If you truly are building like a longer term position and you're able to add more capital every month, right? That's DCAing just means, you know, dollar cost averaging, just buy a little bit more each month with the income that you're putting in and build that long term position.
Yep.
Obviously, Chris and Rocky and others are big fan of doing more tactical trading as well, but for the DCA approach, you can do a portion of your capital with that and then maybe use some of it to do more tactical trading like they do.
Yeah. Look, if you want to juice your returns, or if you want to attempt to juice your returns, because some people screw it up, actually most people screw it up, you can be tactical and you can take setups and you can pay attention to market cycles. If you don't have any time or any desire to do that, take a little bit of money each week, month or quarter or year or whatever, and buy Bitcoin, buy whatever projects you want, stick them on a hardware wallet and forget about it. That's called dollar cost averaging. If you want to be tactical and grow your wealth in a more efficient way, I guess you could be a trader, which is what we do on a swing and a position basis. We're not scalping in and out. We're not day trading. Sometimes we take a whole bunch of trades. Sometimes we take no trades. It depends on the markets. But I can tell you I have way more Bitcoin today because I was tactical than I would have if I just bought and held from 2013. So there's always that to think about.
Yeah. Depends on how involved you want to be.
Yeah. I'm a nerd for this stuff. You know, we live this and breathe this every day. We have other people in the community that, you know, they do it full time. Then we have some people that just are passive and just want to learn what they can. There's no right or wrong answer. Just do what fits your own personality and risk tolerance.
Well said.
Yeah. Awesome. Okay.
Well, we got pickleball. So
We got pickleball. Let's wrap it up. Okay, let me make sure I do this correctly. Smash the like button.
Yeah, you did it.
Yeah, guys, go to wetalkmoney.com. You can submit a question for the show. Subscribe to the audio podcast if you want to listen to this while you're working out or driving down the road. Thanks to Nikki, Travis, and Kevin. And yeah, thanks to YCharts for sponsoring this. And what else? Did I miss something? Join our community, skillincubator.com. Check us out. Or go to wetalkmoney.com/community. And,
yeah, go to wetalkmoney.com and submit a question if you have one.
Yep.
Cool.
Awesome. Yeah, thanks for the interaction in the comments, guys. And we'll see you guys next week.
Yay!
Take care.